Hi, this is Hutch with bankingtruths.com, and today we're going to talk about the fees or the costs inside a whole life policy and what benefits you get for them. Other than just the cash value growth that everybody wants, are there additional benefits that you get from paying those early costs? And spoiler alert, there are two, and I'm going to quiz you on them. But first, let's really unpack what these fees are all about, because if you've done your homework, you realize that whole life is what they call a black box. So actuarially, there's no way for us to kind of unpack or unbundle the fees. That said, what we can do through an illustration, kind of like the blind men groping the elephant, we can see, well, you put X amount in, but X minus Y is showing up for the first couple years. You've probably heard the first years are the worst years. And so ergo, those we'll call the fees or the costs. So let's get into it. Now, you probably recognize the policy we're looking at because it came from the last video in this series where we analyzed taking this 10-pay policy, $14,450, but then front-loading the same dollar amount mostly into the first 5 years and then min-funding it for the next 2 years to make it a 7-pay. And what you saw was more in sooner was better in terms of growth, but in order to have the capacity to fit all the bigger, earlier premiums, we needed to increase the policy size, which also in turn increases the policy cost. So we're going to look at two examples and compare them and show that when you pay more, you actually get something for your money. You get two things, actually. I'm going to quiz you later on. One of them is a trick question, but let's first just look at the cost of the smaller policy, that level 10 pay with the $14,000. In order to fit those premiums in, we need a policy big enough so that the first 2 years, which I always say are the worst years, you're missing $4,083 the first year and then $2,806 the second year for a combined, we'll just call it missing dollar amount, cost, fee, whatever you want to call it, of $68.89. And that's some real cheddar. You've put in $14,000 twice, and $68.89 is missing. Now, again, we're going to see later in the video how you actually get two things for your money. But for now, let's just see how that compares to the bigger policy. When we look at the bigger policy, where we front loaded the same $144,500 into 7 years, the bulk of it going in the first 5, instead of paying $6,800 or having $6,800 missing from our cash value the first 2 years, you can see that over $9,800 is missing from our cash value. And that's significantly more. But as you saw in the last video, we actually ended up with more cash on cash. And that's because the more in sooner factor, compounding, made up for those extra costs. Now let's see what we get for the money. So number one, what you're getting for your money, and most people get this one right, this is not the trick question, is you get a permanent death benefit. And it's a varying amount of from different years. But in this case, in year 4, you have over $220,000 more death benefit. If we look at year 4 with the bigger policy, well, you have $300,000 more of death benefit. And I know some of you are saying, well, I can get term insurance that's a lot cheaper. Yes. But remember, this death benefit lasts for your whole life. And this person, it starts as a 50-year-old. If we fast forward way out by life expectancy, in the small policy, you have just under $100,000. You have about $92,000, $93,000. In the bigger policy, you actually have just over $100,000. So again, we're not talking about a bigger difference, but notice that you did pay more in fees and you recaptured all. You got it all back and then some, at the very least, just with the death benefit. Now, what's the other thing you get for your money? And this is where the trick question comes into play. I'll tell you what you get. You actually get tax forgiveness, which, by the way, is part and parcel to what the death benefit does for you. So the part of the reason why you get tax forgiveness for your growth in whole life insurance is because the federal government and state governments are incentivizing you to buy insurance for widows and orphans that won't ever go away so that you're less likely to suck off the system, so to speak. And for doing that, the growth, you put in $144,000 both times. And with the small policy, your $144,500 grew to $558,000. So the total, call it taxable amount, if you cancel the policy right here at age 86, you would owe tax on $414,000. And let's just say, for round numbers, everybody's tax bracket will be different. Most of my clients think taxes are going up, but let's just say you owe a third of that. Well, you would actually owe $138,000 in tax. So my question to you is, would you prepay, or would you have $6,800 missing from your cash value in the first 2 years, knowing not only do you get this wonderful bucket where you can grow and use as your own bank and use as a retirement buffer, but also that $6,800 gets you $92,000 of death benefit for your heirs over and above. It's like a free burial policy, and like you see the Fonz or JJ Walker advertising on TV or whoever it is. You don't have to pay for those because you already got it. And you're not going to have to pay taxes. You're not going to have to pay $138,000 in taxes. Would you prepay $6,800 now for those two benefits that equal almost $250,000? And most of my clients would say yes. And if you're saying yes, well, then this is probably for you to some degree. And that's what we do, is we help you figure out what that number looks like, because you're probably not a 50-year-old and you're probably not standard, and you can only pay what you can pay, whatever that number is. So now let's look, now that you understand the economic benefit of those missing early costs, or that you're actually getting something for your money, are the higher costs, instead of paying $6,800, paying $9,800 worth it? Well, you get over $100,000 and your tax $100,000 of net death benefit, and your tax forgiveness, or the forgiven taxes that would normally be due, would be on 603 minus 144. It's $458,000. So a third of that, when you just do simple math, is somewhere between $152,000 and $153,000. So you paid more, 98 instead of 68, but you got more tax forgiveness, 152 instead of 138. And instead of 92 with death benefit, you got over 100, a little over 100. Is that worth it? And again, most of my clients would say yes. But wait, there's more. In this example of the bigger policy, I show this client stopping at the end of 7 years, which you can do. At any time past the 7th year, you can always shrink wrap the death benefit. It's called an RPU, or reduced paid up. You can shrink wrap the death benefit and have no more payments due, and basically strip all future mortality black box charges out of the policy and let it grow. But some of you may not be done paying after 7 years. You're still going to have money coming in, whether it's from your job or investments or whatever, and you're going to want to keep them safe and liquid and protected from taxes. Well, with this exact same policy, you could keep paying, and notice they're weird, odd numbers. We didn't pick these numbers. This is just the solve for it's the exact same amount of initial cost and fees, right? You're not paying any more in fees, and you can't pay more than the $25,000, but you can pay it for longer. And after that, you can pay a reduced amount for longer. So by doing so, let's see for the same fees what economic benefit you get. Well, at age 86, you've put in $351,000 instead of $144,000, but your cash value grew to $1.2 million, $1.207, and your death benefit grew to $1,408. So you actually have over $200,000 of net death benefit, and that's because of all the extra dividends and PUAs that you accrued over this time. Now let's look at the so-called tax forgiveness. Well, you have a $1.2 million of cash value. You've paid $351,000. The differential is $856,000. If I just divide that by 3, well, that's $285,000 of taxes that you wouldn't have to pay. You didn't pay any more up front. You paid the same $9,800, but now you've saved, call it $285,000 of taxes, and your family gets an extra $200,000 of death benefit. And all of this is assuming dividends never go up from here. So did you get something for your money? Well, let's see. You paid $9,800. You actually received $285,000 of tax forgiveness, $200,000 of death benefit. Is this a good deal? Let's take a look. Let's measure it. So if we just take that missing money from your first 2 years of cash value, or from our 50-year-olds missing cash value, your fees may even be less. But if we take that missing $6,058 and missing $38.07, and we fast forward from age 51 all the way to age 86, and there was $200,884 of net death benefit that came in, the IRR on that is just over 9%, almost 9.1%. Now, if we take the tax forgiveness, the $285,000 of the taxes that you don't have to pay on the growth alone, and take the same amount of money, well, now it's just over 10%, almost 10.2%. Now, if we add the two together, the tax forgiveness and the net death benefit, and we say, what's the rate of return on paying $6,058, $38.07 for those 2 years, and in the future you receive these economic benefits of $486,000, well, it's almost 12%. So is this a good use of money? Well, you're going to be the judge of that. And again, we can help you compare your own custom numbers. Just sign up with the link below, and we can run all this for you to see what your economic benefit will be. Hope to see you there.